Good morning. I think everybody knows who I am, but in case you don't, I'm Clothier. I'm one of the portfolio managers with Alistair and Peter. And I'm going to talk about risk management, which I'm sure you're all very much looking forward to. So, in 1959, a young mathematician called Ed Thorpe developed a technique for beating casinos at blackjack. And he did that through card counting. And so the idea was that he was estimated the number of high cards that were remaining in the dealer's shoe, and from that was able to predict whether he was likely or not to get a good hand. And he shared the mathematical proof of this with a Bell Lab researcher by the name of Claude Shannon. And the two of them became friends, and they went on to build a machine to beat casinos at roulette. And this turned out to be the world's first wearable computer. And it worked by knowing where the ball was at a given point and estimating how fast it was traveling, and then in turn you could guesstimate where the ball landed. Now, in both instances, these techniques weren't foolproof, but they did remove the edge that the casino had over the punter, and in turn, they got an edge over the casino. Now, before they went and tested these techniques in the wild, so to speak, they decided that they needed to have a betting strategy. If they bet too small an amount, then their capital would compound too slowly. But on the other hand, if they bet too much, they risked engendering catastrophic loss. So Shannon suggested that they should read a paper by another Bell Lab mathematician, a guy called John Kelly. Now, Shannon himself had actually invented an entirely new branch of mathematics, which was called information theory. And information theory, in turn, has its roots in the second law of thermodynamics and entropy. And information theory was concerned with encoding, transmitting, and decoding signals, so essentially transmitting information over a radio wave, as it might be. And in particular, what it did was it dealt with the fact that the transmission would get cluttered with noise and how to deal with that. Now, John Kelly's great insight was to realize that this same branch of mathematics that Shannon had invented could also be applied to probabilistic situations of betting. And essentially, it is a general proof for how much of your capital you should put at risk for a given set of circumstances. Now, what relevance does all of this have to CG and to your investments? And in some senses, the answer is not a lot. So the Kelly Criterion, as it's known, applies to a very specific situation, and that's where you have a binary outcome. You have a defined probabilistic edge, a defined probability of winning. You have the ability to play a large number of consecutive games, and then the outcome of the previous game has no impact on the next game. And of course, as we know, the real world is not remotely like that. Our investment outcomes are decidedly non-binary. We're running multiple positions simultaneously. Two similar positions run concurrently will tend to be highly correlated in the real world. Two similar positions run consecutively will tend to be inversely correlated because, high returns today beget low returns tomorrow. And of course, we're trying to construct portfolios that have elements that are negatively correlated one to the other. But the biggest thing, of course, is that the Kelly criterion applies to a world of certainties. And as we know, the investment world is much fuzzier and much more complicated. And yet, there is one reason why we think it is a useful framework to think about the world, and that relates to humility. And we know from bitter experience that we are wrong quite a lot of the time. And thinking about the world through a Kelly lens enables us to construct portfolios that are able to deal with us being wrong. So, let's start with an experiment. Let's imagine we've got a coin, and when we flip it, it comes up heads 52% of the time. And, very pleasingly, we've got an opponent who will take the other side of that bet in unlimited size and in an unlimited number of instances. And let's also imagine that we're starting with $100 in our back pocket. And the question is, what percentage of our capital should we put at risk in each of our bets? And I'm afraid I'm going to indulge in a little audience participation. So, ladies and gentlemen, here are your choices: $2, $4, $8, and $16. And I'm going to ask for a show of hands. So, hands up who thinks that the correct amount is $2. Mm-hmm. Hands up who thinks the correct amount is $4. Excellent. And who's going to go for $8? Interesting. And finally, $16. Very good. Okay, well, the correct answer, as it turns out, is $4. And it's surprisingly simple to calculate. What you do is you take your 52%, your probability of winning, you double it to 104, you subtract 100, and the 4 that you're left with is the percentage of your capital that you should bet on each turn. But does it actually work? Well, we decided to find out, so we set up a computer to run over the weekend. Think about this. So we ran 10,000 simulations, and each of those simulations contained 10,000 coin tosses, and each of those we did for betting 2%, 4%, 8%, and 16% of our capital in each instance. So that was a total of 400 million primary calculations and several billion calculations in total. And the results were absolutely fascinating. And here are just a few visual examples of what the outputs look like. So, did it actually work? Well, yes, it did. The Kelly beat the twice Kelly bet, the $4 beat the $8, in 98% of our simulations. And it beat the half Kelly in 84% of our simulations. And we also calculated the maximum drawdown for each of our simulations. And this is where it got really interesting. So I want you to guess what the average peak to trough drawdown was for each of those betting strategies. And so, again, you're going to get 4 choices. And again, I'm going to ask for a show of hands. So, who thinks the answer is 25%? And this is doing the correct Kelly bet. So the one that is designed to compound your wealth at the highest rate over time. 25%, any takers? We've got a reasonable number of takers. Okay, very interesting. 50%? 75%? Crikey. 90%. Ooh, we've got a couple of pessimists at the back there. Well, ladies and gentlemen, I'm afraid to say the pessimists have it. The average drawdown in our simulations using the Kelly approach was 92%. 92%. So, I mean, I have to ask the question, how many of you, faced with an investment manager who showed you a drawdown of 90%, would stick with him or her? How many of you would stick with us? I'm not seeing a lot of hands. So the conclusion that we draw from that is that it's not enough to tune our risk management process to maximize the rate at which we compound your capital. Instead, what we have to do is meet the twin objectives of, on the one hand, compounding your capital at an acceptable rate, but on the other hand, retaining you as clients. It's not enough, as it might be, CG to win the investing race. You have to be there with us at the finish line. The second thing that came out from this analysis that was quite interesting was the dangers of overbetting. a number of you suggested that it might be a good idea to put $8 or indeed $16 of your capital on each bet. Well, the average drawdown in the instance of the twice Kelly, the 2 times Kelly, was 99.99%. So we've taken a situation where the odds are quite literally stacked in your favor to one which essentially guarantees financial ruin. And so our conclusion from this is that success in investing is much less about identifying profitable investment opportunities. It's much less about having a particular edge, although of course those things are important. Rather, it's about staying in the game and avoiding catastrophic loss. There was a final thing that we drew from this study, which is a bit less obvious, but in many respects is, I think, no less important for that. And it's this: in order to even adopt the Kelly approach, or perhaps some sort of modified, more cautious version of it, one that might be acceptable to us all, you have to know with absolute certainty what your edge is. And of course, as we know, investing is much, much less certain than that. So what is the probability that you're wrong? And if you are wrong, which way are you likely to be wrong? And as I've said, investing, as we know, is very uncertain. And to borrow the expression from Rumsfeld's, there's a lot of unknown unknowns. There's a lot of things we don't know. And I think all of us know from bitter experience that the things that we don't know when we embark on investment rarely make that investment more profitable. So you can imagine a situation where, hypothetically speaking, you believe you have an edge of 55-45, and the Kelly Criterion would tell you that you need to put 10% of your capital into that investment. But in reality, your edge is actually only 52-48, or perhaps it might even be worse. And you, slavishly following the principles that the formula suggests, it turns out you're actually not betting the Kelly amount, you're betting 2.5 times the Kelly amount. And as we've seen, that is a recipe for financial ruin. So, I guess, in summary, investing is highly uncertain, and it is about peering into the future through a fog. And that very uncertainty means that the bets that we should place are rather smaller than either theory or our instincts might suggest. And so we're often asked, why do we run so many positions in our portfolio? Why are our position sizes so small? Why don't we own more of the things that we love? Why do we hold so much cash? And I hope that this analysis goes some way towards explaining that. And I think the other conclusion is that we draw is that from a practical perspective, following the Kelly approach is next to useless, because our own psychological frailties, whether as investors or investment managers, mean that if we were following it, we'd get carried out by it far before we reach the finish line. Anyway, before I finish, all of this thinking about blackjack and roulette got me to thinking. And I'm sure that many of us at some point in our lives will have had a bright-eyed and bushy-tailed 14-year-old come bounding up and say, do you know, I've got a guaranteed way that you can win at roulette. Really, you say? And they say, yes. What you need to do is put £1 on black. And if you win, great, pocket it. But if you lose, well then next time round you put £2 on black. And then the next time you put 4 and 8 until you win. And of course, mathematically speaking, they are absolutely correct. Your eventual gains will exceed the sum of your cumulative losses up to that point and pay you a profit of your original investment. And this is known as the martingale strategy. And it's something that casinos guard against quite carefully, partly through having the zero number, partly you're only ever allowed to double your bets a certain number of times, and partly they have maximum bet sizes. But we wanted to know, how much capital would you need to pursue the martingale strategy, as we put there, safely-ish? So we decided to define safely-ish as not resulting in a catastrophic loss of all your money in a million goes at playing the martingale game. And so again, on a different weekend, we set up a computer with a virtual roulette wheel, and off it went. And so we played 1 million iterations, because we had to factor in 1 in a million chances of the martingale strategy. And that was a little over 2 million spins of the roulette wheel in total. And we got 19 consecutive losses once in those million simulations. Now actually, as it turns out, that was more or less bang on what theory would predict. The odds of getting 19 consecutive losses are about 0.95 in a million, and we got precisely 1, because you can't get 0.95. So that was all jolly convenient. And the amount of money that you need is actually quite simple. It's this equation here. It's the sum of your initial stake times 2 to the n plus 1, where n is the largest number of consecutive losses that you get, and the plus 1 is needed to keep you in the game and not bankrupt. And that's the amount, £1 billion, which doesn't look like a fantastic return on investment, really, does it? So anyway, what are the conclusions that we should draw from this? That's a good question. I think probably you shouldn't take investment advice from 14-year-olds. If we wanted to throw in some modern investment jargon, we would probably say that it's a bad idea to be short convexity. I think the other thing that we would say is that Peter and Alistair and I really enjoy sleeping well at night. We hope you sleep well at night as well. And one way that we do that is we're not even prepared to expose ourselves to a 1 in a million loss. So this isn't really one for us. But the final thing that I'd say is that, as I hope we've demonstrated, we spend a lot of time thinking about risk, and we think it's not nearly enough to be good at coming up with investment ideas. It's much more important to know how to control those investment ideas. Thank you.